Hello and welcome to Dohna Chien Investment. This analysis is for HDFC Bank on the New York Stock Exchange as of 4th of August 2026 with a share price of $23.84. The full report is on dohnachien.ca. HDFC Bank is India's largest private sector bank, a quality 80 lender with the sector's best asset quality. The long-term call is a buy on a cheap franchise near a decade-low valuation. Short and medium are hold. Net interest margin is at a record low 3.26%. The tape is near a 52-week low, and an oil spike to about $90 pressures the rupee. HDFC Bank is India's largest private sector bank by assets, deposits and market value, lending across roughly 9,000 branches. The model is classic banking. Gather low-cost retail deposits, lend them out as home, vehicle and business loans, and earn the spread plus fees. What sets it apart is decades of the sector's best asset quality. Gross bad loans around 1.2%. Very strong capital at a 17.3% core ratio, and excellent efficiency near 40%. Business quality is high at 80, and it is that durable franchise, bought cheaply, that carries the long-term call to a buy. The valuation pillar scores 64, cheap versus its own decade of history, fair on the rate and growth anchor. Price to tangible book is 1.88 times, against a warranted 1.85, so it sits right at fair. A rising US 10-year yield at 4.75% lifted the discount rate and offset the low multiple. The near-term problem is the margin. Net interest margin fell to a record low 3.26%, down from 3.38, as repo-linked loans reprice faster than deposits. Analysts carry a 33.95 target, about 42% above the price, but rate the shares only a hold. In banking, a compressing margin is exactly what keeps a cheap stock cheap. The tape and the macro seal, the short and medium calls. Timing is weak at 31, strongly bearish on every time frame, with the ADR churning near its 52-week low of 22.66 and well below both moving averages. The backdrop worked against it too. An oil spike to about $90 a barrel is a direct headwind for an oil-importing economy, feeding inflation, the current account and a weaker rupee, and the long horizon has lost its macro tailwind. The long buy is now a contrarian call, backed by quality alone. So own it for the long term at a cheap price, but wait for the tape and the margin to stabilize before adding. The risks point at the same two lines, the margin and the rupee. If the oil spike persists, the rupee slides and the central bank is forced to pause or hike, net interest margin stays compressed and emerging market outflows continue. A D rate toward 1.5 times book, and the roughly $19 bear case, about 20% below the price. The stop sits at $22.50, only about 5.6% below spot, and just under the 52-week low, so a break there is the single biggest near-term watch. Rival ICICI is out-earning HDFC on margin and return on equity, and payments fintech slowly chips at low-cost deposits. The floor under it all is the valuation itself. A decade-low multiple on a pristine, well-capitalized book. Now weigh the risk against the reward. The bull case is roughly 43% above today. The base case, the most likely, about 17%, and the bear case, a fall of about 20%. So you are risking about 20 to make 43. So, our call on HDFC Bank on the New York Stock Exchange, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Dohna Chien Investment at dohnachien.ca. The link to the full report is in the notes below. Have a great day.